So a huge new law just landed, and it's promising to finally tame the wild world of crypto. But what if its biggest feature is actually a bug? Let's dive into the real story behind the new Genius Act.
And really, this is the core question we're tackling today. A brand new law is supposed to make stablecoins, those digital currencies pegged to the dollar, finally safe. But get this, what if a tiny loophole in that law could let them be backed by one of the most volatile assets in the world?
Okay, so let's start with the good intentions. The Genius Act, which got signed this past July, was supposed to be the new sheriff in town for the Wild West of stablecoins. The whole idea? Finally bring some law and order to the crypto frontier.
And you can't overstate it, this was a massive deal. For the very first time, we had a real, official rulebook for stablecoin issuers in the US. This was supposed to be the moment crypto regulation finally grew up.
But, and there's always a but, isn't there? This is where the plot thickens. According to Federal Reserve Governor Michael Barr, we shouldn't think of this law as a finished skyscraper. He says it's just the foundation, and as we're about to see, that foundation might have some pretty serious cracks. And that idea of a cracked foundation is just the perfect way to think about this. Because, a foundation's a great start, but if it's full of leaks and weaknesses, the whole building is at risk. And that's exactly what people are finding as they look closer at this new law.
In fact, experts have pretty much zeroed in on three major areas of concern. First, what's actually allowed to back a stablecoin. Second, a messy system of who's actually in charge of watching them. And third, the fact that some of these tokens aren't even covered by the rules at all.
So let's zoom in on these loopholes. We're going to break each one down to really understand the dangers they could pose. And we're not just talking about risks for crypto investors, but potentially for the entire financial system. All right, loophole number one, and this one's a doozy. The law says a stablecoin company has to hold reserves to back their coins. And one of the things they're allowed to hold is any medium of exchange recognized by a foreign country. Now, on the surface, that sounds pretty reasonable, right? But the devil is always in the details. And this is where it gets absolutely wild. The country of El Salvador officially recognizes Bitcoin as legal tender, an official medium of exchange. So a clever company could point to the text of the law and argue that super volatile Bitcoin is a perfectly fine asset to hold in reserve. Just imagine a stablecoin that's backed by anything but stability.
And the risk doesn't even stop there. The law also allows uninsured bank deposits to be part of the reserves. I mean, we don't have to think back very far to know why that's a huge red flag. It was a classic bank run on uninsured deposits that caused Silicon Valley Bank and Signature Bank to collapse in 2023. This law could be baking that same exact weakness right into the crypto system.
Now, the second loophole creates something experts are calling a race to the bottom. An issuer gets to choose who regulates them, from 4 different federal agencies, plus any state regulator. So if you're a risky company, what do? You go regulator shopping for the one with the easiest rules. And that means the weakest link in the chain could put the whole system in jeopardy.
And the third loophole is simple, but it's a big one. Not every token that looks and acts like a stablecoin is actually covered by this new act. So you'll still have these dollar-pegged tokens operating in that Wild West totally unregulated. That just creates a ton of confusion for users who might think they have protections that they absolutely do not. Okay, so the Genius Act clearly has some serious flaws. But is there a better way to do all this? Well, a lot of experts are saying yes. Instead of trying to build a whole new financial system from scratch, they say we should just upgrade the one we already have with something called tokenized deposits. And the concept is actually really simple to get your head around. A tokenized deposit isn't some new kind of private money. It's just a digital receipt. It's a token on a blockchain that represents real, actual dollars sitting in a traditional, insured, and regulated bank account. And when you put these two side by side like this, man, the difference is just night and day. Stablecoins under the new law, they can be backed by risky assets and uninsured cash. Tokenized deposits, backed one-to-one by insured money in a bank. Stablecoins have that fragmented, confusing oversight. Tokenized deposits fall under the same trusted banking rules we've had for ages, with the same safety nets like FDIC insurance. It's not even in the same league.
So this all leaves us at a fork in the road. We're looking at two very different visions for where digital money goes from here. It's really a choice between building something brand new and risky or taking a system we already trust and just making it better with new technology.
And this really lays it out. Path 1 is the world of the Genius Act, a whole new financial system built on a patchwork of untested rules. Path 2 is totally different.
It's about using this powerful new tech to upgrade the banking system we already know and rely on.
And that brings us to the final critical question. The Genius Act is a foundation, no doubt, but it might be a flawed one. So the choice we're facing is this. Do we build the future of money on a brand new set of rules with a bunch of unknown risks, or do we use new tech to upgrade the systems we already trust? The answer to that question is going to define digital finance for decades to come.